To make money investing, it's extremely important that you understand the basics before anything else. That's why by the time you leave this video, you'll confidently know how to use each of the 5 simple order types available on Webull. That's a market, limit, stop, stop limit, and trailing stop order type. I'm not only going to fully explain how each of these stock market order types work, but I'm also going to provide an example of using each. I'll explain the advantages and the disadvantages, and of course, when it makes sense to use each one of these order types. Some order types solve the problems caused by other ones, so it's really important that you understand each of the 5 so you know which one to use in your situation. That said, make sure to grab a pen and paper, your favorite studious drink, and stick around through the entire video so you don't miss any key information. Jumping into the Webull app, the first thing that you need to make sure of is that you've not only signed up for Webull, but you've submitted a brokerage application that has been approved. Now, Webull's offering new users 6 to 12 free shares of stock worth up to $30,600 as a sign-up bonus. So if you haven't yet signed up, I've left a link in the comment section below, which will take you directly to that sign-up page where you can take advantage of those free shares. To access the order types, head to any stock that you want. For this video, we're gonna pull up Tesla. So I'll click that from my history here. We'll hit trade in the bottom left corner. And if we change the order type here, you'll see that there are 5 simple order types and an additional 5 group orders. Those are more complicated, so we're gonna leave those for a future video. Starting with the most popular and easy to understand, we have the market order. When placing a market order, what you're effectively saying is that you wanna buy or sell stock at whatever the next available price is. Now, many don't realize that when you pull up a stock, the number that you see isn't necessarily the number that you'll pay when buying or what you'll receive when selling shares of a stock. Right above where you select whether you're going to place a buy or sell order, you'll see the bid and ask information. This is actually the information you want to pay attention to because it gives you a better idea of what you're going to pay for stock or receive for selling. The bid price represents the highest price that buyers are willing to pay for shares of a stock, while the ask represents the lowest price sellers are willing to sell for. You can think of this as supply and demand. The ask side represents the sellers, the people with the shares of stock, and the bid price represents demand, the people who want to buy shares of stock. So what you're saying with the market order is that you're willing to pay whatever those sellers are asking for right now, while on the sell side, you're willing to accept whatever the buyers are willing to pay in order to offload your shares. For example, let's say that I want to buy 1 share of Tesla, so I'll enter 1 for the quantity, and then you'll see the estimated amount towards the bottom of the screen there. This number is likely to fluctuate a little bit because remember, you're willing to pay whatever the next available price is, and that price is always fluctuating. When placing a market order, it'll execute almost immediately unless you're trading very liquid stocks with little trading activity, but this is something you should never run into trading stocks like Tesla, Apple, Nike, or Nvidia, for example. Now, the main advantage with a market order is the speed of execution. Now, if you're less concerned with price, but more about how fast the order goes through, how fast you can own the shares or offload them, then this is the order type that you'd want to use. Now, a couple disadvantages include not being able to choose a specific price like some of the other order types allow you to do. And second, if you place a market order for a stock that's experiencing super volatile conditions, what you actually pay or receive for buying and selling may be quite a bit different than the last price that you saw. The next order type we're going to cover is perfect for those less concerned about how quickly a trade goes through, but more concerned about the specific price. Next is a limit order. This type gives you a lot more control over the exact price that you buy or sell at, but much less control over how quickly the trade executes. When placing a limit order, what you're effectively saying is that you're only willing to buy or sell at a specific price point or better. If the stock doesn't reach that price point you set, the order will not execute. So let's now say that I want to buy 5 shares of Tesla, but the current price is not cutting it for me as a good entry point for a long-term position, but rather I'm thinking more of a price point of about $155 per share. I'm going to change the order type to limit, and then for the limit price, I'm going to enter 155. Next, enter 5 for the quantity, And then when I go ahead and submit this order, it will not execute unless the ask price of Tesla reaches 155 or lower. When placing a limit order, you'll want to pay attention to both trading hours and time in force. Because it can take time for your limit order to execute, you have the option of allowing it to be open and available during both regular hours and extended hours trading sessions, as well as leaving it open and fillable for up to 60 days. One of the main advantages with this order type is the high level of control you have over the price. It can ensure that you receive a guaranteed minimum when selling shares or pay a guaranteed max price when buying shares. One disadvantage here is that you have less control over the execution speed. So if you're less concerned with speed, but more about the specific price, a limit order is a great option for you. The third order type is a stop order. Now we're mainly going to be talking about a sell stop, but keep in mind that a buy stop is an order placed at a price above the current market price. This is used by traders to capture a breakout in upward price movement, and it's often used by short sellers to limit potential losses. When you place a sell stop order, what you're doing is setting a price below the current market price that you want a sell order to trigger at. So if you were to buy 5 shares of Apple stock at a price of $150 per share, but you wanted to limit your losses and sell those shares if Apple stock fell to $140 or lower, you could set a stop at $140. If and when Apple falls to $140, your stop price, a market sell order will automatically be triggered. And remember, because it's a market order that executes very fast, your shares will sell off at the next available price. So I own about 14 shares of Verizon stock in this account, but let's say as an example that I want to sell all 14 shares if Verizon reaches $35 or lower. It's currently trading in the neighborhood of about $37 per share. From the trade screen, I'll make sure the sell side is selected and change the order type to stop. For the stop price, I'll enter 35. And for the quantity, I'll hit close all. And then for time in force, I'm going to click good until canceled, which again, will leave my order open and available for up to 60 days. Now, if I were to submit this order, I'd have downside protection automatically in the case that Verizon fell to $35 or lower. There are a few downsides though that you need to be aware of. First off is that there's a chance that your order will not execute at or even near the stop price you set. This is because when your stop price is met, it's automatically converted to a market order, which again is going to execute at the next available price. So if the stock you're trading is plummeting in a price, or it closes the trading day above your stop price, but then there's some bad news overnight, it could open the next trading day significantly lower than the stop price you set, selling off your shares way lower than expected. The good news though is that the next order type we're going to talk about solves this issue. But first, why should you use a stop order in the first place? A stop order is a great way to limit losses and protect gains, especially when trading stable stocks. Verizon stock, for example, doesn't often see huge swings in price, so I'd feel comfortable placing a regular stop order, but Tesla stock would be a different story. The reason for that being that it's more likely that the executed price would be further away from the stop price I set because the stock is a lot more volatile. And that leads us to our fourth order type, the stop limit. This is really similar to the regular stop order we just talked about, except when your stop price is met, a limit order is triggered instead of a market order. With this type, there's one more layer of protection which combats the issue of the potential price difference between the stop price and the actual execution price. Just like a regular stop order, you'll set that initial stop price, but then you'll also set a limit price. Back to Tesla, let's say that I want to set a stop price at $165 per share, but the lowest price I'm willing to accept is $160. To make this easier to think about, break up each part of the process into separate orders. The first part of the order would be choosing a price that you want the sell order to trigger at, the stop price, and the second part of the order would be setting up a limit order. So if or when Tesla reaches $165 per share, a limit order is automatically submitted for you that effectively says that you're only willing to sell your shares as long as they can be sold for $160 or higher. This solves the issue of a large price gap. For example, if Tesla closed the trading day above the stop price we set, but then had some sudden bad news overnight and opened the next trading day at $140 per share. The main advantage of of a stop limit order is that you have a lot more control over the price, and in the situation of bad news overnight, you wouldn't sell out of your shares way lower than expected. Now, a disadvantage here is that you may be stuck holding devalued shares that you could have gotten rid of at a higher price had you submitted a regular stop order, which would have sold them at the next available price. A stop limit order is a great option for you if you want to get out of a position, but you don't mind holding onto the shares unless you can get a desired price or better. The fifth and final order type we're covering in this video is the trailing stop. This order type is also used to protect gains and minimize losses. The difference here though is that the stop price that you set is flexible rather than fixed. By placing a trailing stop order, what you're saying is that you want your position to stay open as long as the stock is moving in your favor, but if it reverses by a certain dollar amount or percent from its peak, you want your position to be sold automatically. The key to understanding this order type is that the stop price is flexible and tracks the peak price of the stock. So let's do an example with Tesla here. I'm going to make sure the sell side is selected, click trailing stop, and then for the trail amount, you can either enter a specific percentage or dollar amount. We're going to do 15% for this example, and then a quantity of 5. To keep this example as easy to understand as possible, let's say Tesla share price is an even $170 when this trailing stop is set. Now that the trailing stop is set, let's say Tesla rose from 170 per share to 180. The initial stop price would be 144.5, as that's 15% below 170, to a new stop price of $153, as that's 15% below the new peak of 180. And then let's say 180 is the highest share price that Tesla hit before reversing and trending downward to a price of 165 per share. My stop price still sits at 153 because remember, the trailing stop can only rise. Now, the trailing amount that you'd want to set really depends on what you're trading. If you're trading a very volatile stock like Tesla, it makes sense to have a larger percentage or dollar amount as your trailing stop. In comparison to trading more stable stocks like Verizon, for example, it's important for you to look at regular swings in price for the stock you're trading. That way you can set an appropriate trailing amount so you don't end up selling prematurely because of a regular pullback in the stock. One major advantage of this order type is that it provides you a lot more flexibility and control in protecting gains and limiting losses in comparison to the other order types we've covered. Now that you understand each of the 5 simple order types on Webull, you'll want to check out this video here, which is a complete guide to getting started with and using the app.